Ladies and gentlemen, welcome back to the channel. Here in this video, we are going to be going over everything you need to know on AMC stock. And let me tell you right now, don't be surprised if you do see a parabolic rally start in AMC or other names here shortly into the future. We'll talk about exactly why that is here in this video. And I've spoke about this briefly in other videos, but I do think we need to really put that as the headliner of this video because it could start here soon. And I want to break down exactly why that is and how this could ultimately take place. So let's get into it, guys. Hit that like button and subscribe to the channel. Let me know what you think about this information down below in the comment section. So first things first, let's start with why AMC stock, and it's not just AMC stock, but the broad secular kind of small mid-cap area could start on a pretty parabolic rally. Now, I do want to preference, I think some of the most beaten down stocks could rally the most, right? A stock like an SMCI, for an example, the largest stock in the Russell 2000, that sucker might not rally as much as an AMC would on a percentage basis, because one of them is up 70% in a month, and they do report earnings today and after hours, so that's going to be a big factor of tomorrow as well. The Russell index itself could either see a big move up or big move down tomorrow just based on that alone. But again, some of your stocks that have gotten beaten down the most could rally the most over the next couple of days. Okay, so let's explain this the simplest way possible. The Bank Term Funding Program is a program in which if a bank bought bonds in 2021 or 2022 or the beginning of 2023 and they're upside down on their face value of the bond. So there's two things banks can do when they are flushed with capital. In general, there's two things the banks can do with customer deposits. If you deposit your money into a bank, that's a customer deposit. They can give loans and they can buy treasuries. Well, for the last couple of years, people have really not been taking out loans, and especially even now, people are not taking out loans like they were before. So the banks basically had no choice but to go out and buy a bunch of treasuries. Now, some banks bought long duration treasuries and did poorly, like a Bank of America or Citibank. Other banks like JP Morgan and Goldman Sachs, they went out and they bought short duration bonds, so they were much better off. As those bonds come to maturity, their face value didn't lose as much. Now, there's two different ways that banks buy bonds. They buy held to maturity bonds, and they buy bonds that are marketed for sale in the future. Like if there's a big withdrawal or, you know, a bank run, God forbid, they have a certain portion of their bonds for long term. They're not going to touch them. Held to maturity, they're going to collect their 4% or whatever on a 10-year treasury. And there's some they buy, which are usually short duration, that are able to be sold and actually, fund their operations. Now, essentially, for these upside down banks like Bank of America and Citi that bought too much of these long duration bonds, they can go to the Fed and say, hey, Fed, we have these bonds. We have like 100 billion worth of these bonds. We bought them for 100 billion. They're worth 60 billion now. Will you take them off our hands and give us 100 billion? Give us the full value back? The Fed says, yeah, we'll do that with the Bank Term Funding Program. Well, the Bank Term Funding Program started due to the banking crisis in March. And you can see that's where this thing really exploded. Even in September of 2023, so not that long ago, you were at about 107 billion in the Bank Term Funding Program. Even since then, long after the banking crisis has been over with, you're now seeing $167 billion in this Bank Term Funding Program. Literally at an all-time high the last time we got data, which was January 24th. So I imagine it's even higher than that now. Well, the Fed just came out on January 24th and said, we're no longer going to issue new loans to the Bank Term Funding Program. Now think about it like this. Why are they doing that? There's only literally one logical explanation for that, is because they are going to stop quantitative tightening. Now, to understand this fully, you have to probably look at a chart of TLT. So this is on a weekly chart. A lot of banks, again, bought bonds in this area where my cursor is, where, they just bought them too high. Now, this is TLT. It's an ETF that tracks the 20-year treasury. Same applies, 10-year, 20-year treasury. Roughly similar pricing you're going to see for both of these charts. Now, as the Fed has been selling 60 billion of treasuries a month, 30 billion of mortgage-backed securities a month, well, look at this chart. It's been going down. The price has been going down, part of which is due because the Fed has been selling 60 billion worth of treasuries every single month, like on a monthly basis. So over the past, 18 months or so, as they have started quantitative tightening, let's see, just a quick little calculator here. Let's do 60 billion times 18. So the Fed has essentially sold over $1 trillion worth of bonds onto the marketplace. That has, if you will, artificially risen long duration yields. And again, part of that is that the Fed's doing this. So other investors, they go out and short treasuries as well. And it has this cumulative effect on pushing yields higher, especially on like the 10-year treasury yield, right? Nobody expects Fed funds rates are going to be 4+% in 10 years. Nobody thinks that. But 10-year treasuries are at 4% essentially because of these factors that are pushing bond prices lower. So bonds work like a dividend stock, right? If you buy a $100 dividend stock that pays you $5 in dividends a year, that's a 5% yielding dividend stock. Let's say nobody all of a sudden wants to own that dividend stock anymore. The company keeps its dividend at $5, but let's say the share price of that stock drops to $50. Now it's a $50 stock and it pays you $5 a year. Now it pays you 10% because nobody wanted to own the stock. Same story here. Nobody's wanted to own treasuries, so the yield has been rising because the actual dollar amount of treasuries has been falling. Again, that selling pressure because of the Fed being a big factor here. That is called quantitative tightening. Quantitative easing is the Fed buying bonds. Now, if the Fed buys bonds and this chart were to rise and the yield stays fixed, but again, for the analogy that we just used, $100 stock pays you $5 a year in dividends, that's 5%. Let's say the Fed does quantitative easing and now the stock is $200 per share, but it still pays you $5 a year in dividends. Now it's a 2.5% yielding stock. Same thing is exactly true for bonds. So quantitative easing is the Fed buying bonds. Now, the Fed may go to quantitative easing. I think it's improbable that that happens right now, but just the ending to quantitative tightening is going to make a lot of investors start to buy the bonds because that's going to say the Fed's no longer adding this artificial selling pressure. We should probably go long on the bonds here because we're expecting interest rates are going to fall. That just looks like a literal no-brainer bet to me. Go long on the bonds. Now, that's not a recommendation. That's not advice. None of that. That's just my expectation overall. And that's personally what I plan on doing as well. So this effect can take a lot of money off the sidelines that is currently in money market funds, which money market funds have been benefiting from higher 10-year, 20-year treasuries, and take that and put that back into stocks. There used to be a saying called TINA, there is no other alternative. Today there is. If you can get 4% or so in a money market fund, there is an alternative, closer to 5% at one point. That's why $6.2 trillion is currently in money market funds. And if you look at the total value of the Russell 2000, it's only about $2.3 trillion. So just a fraction of this, let's say 200, 300, 400, 500 billion dollars coming out of money market funds into a Russell 2000 is dramatically going to boost, small mid-cap stocks, your interest rate sensitive names, your bottom half of the markets, if you will, because stocks have been hitting all-time highs, not because stocks generally have been doing well, but because your Magnificent Seven stocks have been doing well. I don't think the money is going to go into those names. I do think the money will go into small and mid-cap stocks. Now, I think this is largely something that's going to catch the markets by surprise. I don't think you're going to hear a lot of people say that the Fed's probably going to end quantitative tightening here coming soon. Now, they might not end quantitative tightening on Wednesday, but and Wednesday is when the Fed meets on January 31st. It's going to be this Wednesday at 2 p.m. You're going to get the report. 2:30 p.m. You're going to get the actual press conference. I don't think the Fed's going to stop quantitative tightening coming Wednesday, but they're probably going to strongly signal or maybe outright tell the markets by March they're going to end quantitative tightening, because the Fed announced on January 24th that they were going to stop the bank term funding program, new loans being issued, by March 11th. The next Fed meeting after this Wednesday is March 20th. So if the Fed signals now that they are done quantitative tightening, well, that means treasuries are going to start rising. That means that again, for that same analogy that we use, a bank has 100 billion of, let's call it Bank of America, 100 billion worth of bonds that they bought. Now those bonds are worth 60 billion. Let's say they're upside down 40%. If the Fed signals an end to quantitative tightening, maybe the bonds rally 20% or so, maybe more than that. And what happens? The unrealized loss becomes less. Maybe the bank now has 80 billion out of that 100 billion they initially bought the bonds for, because the Fed did this action that I expect on Wednesday. That means the banks probably don't need to use the bank term funding program anymore. Maybe their losses are not, 40% anymore. Maybe they're 20%. Maybe not even 20%. Maybe bonds fully make a comeback back to the, 115, 120 range. That's a possibility. So I do think this has that effect where it'll pull money into our markets as rates go lower. Now, there's always the off chance, always the possibility that markets say, well, why are you doing this? Is there something bad that we should know about? The reason why you're ending quantitative tightening? Or maybe they don't even have to end it. Maybe they go from 60 billion of selling of treasuries a month to 10 billion in selling of treasuries a month, or 15 billion, 30 billion, who knows? Any of that is going to be very positive for small and mid-cap stocks specifically, but for our markets generally speaking. So I do think a pretty parabolic rally could be in store for stocks like AMC, for other small and mid-cap names. Now, let's take a brief overview of what's going on today with AMC stock and even the data you need to know for tomorrow. So you do have 10.62% short interest of free float, $108 million worth of short positions in AMC, 1.42 days to cover, 26.6 million shares currently out on loan, or short interest. 26.6 million shares sold short, 24.53 million shares currently out on loan, cost to borrow 1.08%, utilization of 38.3%, and a short score of 59.35 out of 100. Cost to borrow max sitting here at about 5.82%. Now, if you take a look at some of this option activity, you did see a trade come in here that I actually really like. I think pricing here is very attractive. For January 17, 2025, $10 strike. This hedge fund or firm or institutional investor bought 10,000 of these contracts for $56 a piece, for a face value of $560,000. I mean, that is a pretty attractive damn trade there. I think AMC stock can easily get back to $10 per share. If you think about the average, price target is around $8 per share for AMC stock from hedge funds and institutions, analysts on Wall Street. To go above that and hit $10 per share, it's not off the table here. It's probably likely as we get towards the back half of the year and the Fed is cutting rates, quantitative tightening is basically over with. Yeah, that's going to have a big effect on a stock like an AMC. Part of the reason why AMC is $4 per share, not all of it, but part of it, is because there's no money going into our markets. There's no money going into small and mid-cap stocks. Tom Lee says that the best. The reason why your average stock has done so poorly, look at PayPal. PayPal is priced as if the company has a decent chance of going bankrupt. It's trading at like 10 times this year's earnings. It's egregiously cheap. It's less than half the valuation of the S&P 500. But why? Because there's no money going into a stock like a PayPal. Retail investors, sure. hedge funds, institutions, they are not jumping over themselves to buy PayPal or AMC or SoFi or Fubo or Palantir or DraftKings. It's mostly retail investors buying those kind of stocks. Once the Fed gives investors a reason to buy those stocks, that's when they will start to perform very well. That's when they will start to outperform, and that could start by this Wednesday. Do not be surprised when that happens. Now, if you look at the option activity for AMC stock today, about 8,000 calls currently in the money, about 49,000 calls out the money. In the money puts at about 21,000, out the money puts at 27,000. So definitely some dry powder, if you will, on the sidelines, where you could see quite a large rally in AMC stock if you do see this pivot, like I think is possible. So let me know what you think about that down below in the comment section. Now, coming tomorrow, or really tonight, you're going to get a lot of GDP data out of Europe, GDP data out of France, out of Germany, some data out of the UK as well. You are going to get the GDP growth rate quarter over quarter and year over year coming out for the European area itself. All of that expected to be big news. Tomorrow morning at 9 o'clock in the morning, you're going to get the Red Book, as well as the S&P Case-Shiller home price month over month and year over year. Month over month is expected at 0.2%. Last month was 0.1%, and year over year expected at 5.9%. So generally lower the better there, meaning maybe less housing inflation. You are also going to get Dallas Fed services, Dallas Fed service revenues. If you see a plummeting there, like you've seen like the Dallas Fed manufacturing today, well, that's not going to be all too great, but definitely something to be watching out for. The biggest thing of all is going to be the JOLTS job openings tomorrow. You're expecting a little bit less job openings. By a little bit, I mean about 100,000 less job openings. If that were to fall like 3, 4, 500,000, job openings, well, that would obviously not be great. So definitely want to watch that. A big plummeting here would not be good. A little bit of a decline here would probably not be, terrible. But a big plummeting definitely would not be good. So there you have it, guys. Not too much else to actually say. Everything else seems to pretty much look about the same today. I did just want to point that out, though. AMC stock could start to go through quite a large rally by the end of this week, even today, considering you did hit a new multi-year low, and it seems like almost instantly you got bought up, and now you're up almost 3% here on the day today. So hit that like button as well as subscribe to the channel. Let me know what you think about this information down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.